everyone. Welcome to another episode of the Eitel Insights podcast. Last week we took a look at the detached market for the month of September. We're going to do the same for the condo market. Usually there's a bit of a broader customer base for condo purchases, so we get certain comments that come in for the detached market, and we always get interesting ones for condos too. So hopefully we'll be able to pique your interest here. So Dane, how's it going this week?
It's going excellent, other than the gloomy weather that we seem to be experiencing, and it seems to be here to stay for the considerable amount of time. So other than that, fantastic.
Yeah, for sure. Well, I mean, we'll do our best to liven up people's days a bit and maybe bring a little bit of entertainment and a little bit of useful information too.
You got it.
Cool. So let's dive right in. The condo market, we had a little bit of an uptick here in the prices. So can you talk a little bit about what that means for the market as a whole? Is this something that we need to start paying attention to? Is it a temporary blip in the radar? What are your thoughts there?
Yeah, so I mean, it was an interesting data point. The data actually did come in at 673,000, which is an uptick, roughly, let's say $22,000 than the month previous, which isn't a whole ton in the grandiose things of the selling range. However, what it was a technical break of the downtrend, and we kind of had advised over the last few podcasts that something interesting was going on here in this chart, technically speaking. And what we meant by that was basically a combination of this market not wanting to break the second yellow line on the chart, and simultaneously being forced lower because of the previously established prices. So one way or the other, the market had to give. Eventually, the market actually exploded a little bit up, like I say, to the tune of 22,000. Now, this isn't, in our opinion, a breaking of any longer-term trend. This is just, a happenstance. I mean, we'll get into the data here, and we'll give some justification as to why the market's a little bit broader and more appetizing to some aspects of the market compared to definitely where it has been in the peak times. So, but yeah, we saw an uptick. Like I say, we're still planning on going lower longer. What will ultimately more than likely happen here is we'll hover around this secondary yellow marker, which we've already broken previously. And again, you can see on the chart here, let's take it back basically about a year. There was about a quarter of time where no movement was going on in that market just above that yellow line. Subsequently, it had to go down lower. Psychologically, this market doesn't want to go lower. No market really does until it's actually forced lower. So there was an instance here where it said, you know what, the yellow line is going to be our temporary bottom, the secondary lower one. We're saying, cool, that's great. It's more than likely, I mean, for our forecast, it's going to trend lower again. Ultimately, this market, we do believe, is going down to 525,000. So it's basically another 20% from where we're at today. The market had already dropped off roughly 15% in previous instances when the prices were lower near that yellow line. So, there's an opportunity here for some sellers that there haven't been for a long time. Now, is it 2016 opportunities? Is there going to be multiple offers? There could be a few multiple offers, actually, right? And that's that kind of fun part about this market, if you price it sharp. And now pricing it sharp is being realistic to the terms, and again, forecasting it going lower longer. It's not, going back to the peak of the market, and it's really not even going back to, something 2 years ago or a year ago for that matter. It's still that psychology of going lower longer. There is more and more inventory as we go forward in time, so your competition is there. But over the summer, there wasn't a ton of inventory that kind of came onto it, right? Yeah. So, and we can get into that here a bit later, but that's kind of what we see here. The prices were down roughly 15%, a bit of stress test mitigation. And also there has been stress test mitigation in the detached market. So it kind of just opens everybody up to being in a purchasing mindset. And there is always a subset of a market that has to move, has to purchase, has to sell, right? So, and I think that's what we're having a little bit of realization in that market, that some folks have had that chance to sell. They've needed to sell for a while, and they actually got somebody that'll nibble on their line, and they reeled the fish in and got a good deal. Depends on your forecast, right? I mean, sellers we still think should be selling if you're in a need base. This isn't the end of the doldrums. They're still very much in front of you, unfortunately. So if you're in a place where you're thinking that you had to sell 6 months ago and you're praying to God that it was going to bottom and revert back, unfortunately, we don't believe this is it. Everyone's entitled to their opinion, but analytically speaking, we're nowhere near a bottom.
Okay. Just anecdotally, I have some friends and family that bought into a townhouse complex in White Rock a couple years ago, and it was on a pre-sale. So
Right.
So they, I mean, like everyone else, and you can't really fault them for it, but they expected that they were going to see a giant price bump, and they were going to unload the property at a profit before it even got built. And what's happening now is, as generally as Eitel Insights has called, right before it's kind of completed, they're having a tough time unloading these properties, right?
Absolutely.
And they can't sell. So, is kind of reading in between the lines here, this temporary blip here, do you think this might be a good opportunity for people like them to aggressively price their condos and kind of unload them, at least break even on them, even though they might not get a profit?
If that's, if their risk reward is that they're having sleepless nights about it already and they're not really a real estate investor, unfortunately, they invested at a wrong time, right? Yeah. So they invested right at the peak. And maybe right before the peak, and it went up a little bit, and now they're kind of at a net equal, if not a net negative.
Yeah.
And for those folks, I mean, just get out, put your cash back. There's going to be another opportunity to purchase when we're nearer to a growth phase, right?
Yeah.
And that's where you're actually going to be having restful sleeps, because we're, month after month, quarter after quarter, it's increasing in price.
Okay.
Where we're at right now, I mean, technically speaking, depending on how the White Rock chart looks for the townhouse market, that's how we actually would give them personal advice, right? Okay. But overall, just kind of speaking, especially with the condo pre-sales that have gone on, there's going to be a lot of trouble ahead. Again, anecdotally speaking, with a friend of mine, he says that he deals with, he's a rental manager, and they got people that are, bought 30 apartment buildings.
Yikes.
30.
Oh, wow.
Right? Yeah. And in a pre-sale, and he estimates there's several hundreds of those, and 90% of those several hundreds that purchased were all strictly investments. Yeah. So all of those will inevitably show up on the rental market, on the resale market, and that's why we're saying, really, truly, this lower longer is not over, right? It is a blip, and I mean, it's not a stock. It can't fall out of bed overnight.
Right.
And truthfully, if you follow back and maybe watch a few of our other podcasts, you'll see a similar chart on the detach. The first time that it actually tried to break this yellow line, it snaps back and it says, it's almost like a petulant child. Like, I don't want to. Yeah. I don't want to. Right. Until, it says you have to go to bed. Right. Then it goes to bed, right? Yeah. So we're at this place where the market's saying, I don't want to go lower, and there isn't enough impetus or causality to force it lower at this period of time.
Right.
In 6 months from now, probably be a different story. We'll probably be back down testing that lower yellow line again. A year from now, we're definitely lower. 2 years from now, we're closer to the bottom.
Right, exactly.
Right.
So there's not kind of an immediate spark to force it to go lower, but it's hard to buck the general trend or disrupt the general trend that it's going lower.
Absolutely. And I mean, you can take a look again here at the chart that we had up earlier. And I mean, you see how many times it tested this downtrend at the top, and it just forced the market lower until there was a little bit of a base in there, which was created by this yellow line. And that's one data point of previously established prices on the way up. And that's how good we are, is that one data point actually has a huge parameter indicator as the future prices. Who would have known that prices would have halted right around 651? Well, that's why we put our yellow line there, is because we did indicate that's where exactly prices would halt for a short term, or this is a technical indicator that has to be paid attention to. Right. And that's how we produce our charts.
Great. So shifting a little bit into the inventory data, I mean, sometimes there's a correlation between sales price movements and the number of sales, but what happened this month?
You know what happened with inventory? Yeah. We actually went up a total in month over month of one property. So the actual inventory in August was 5,182. September was 5,183.
Okay.
Another oddity, we'll put the chart up here for you again, is we're smack dab up against that aggressive uptrend, right? And kind of above that downtrend that we've already broken out of. It still wants to, I mean, it's more of a, in the relative strength of this chart, it's still going lower because we had so much time around 8,000 and it experienced this kind of downtrend after bucking that trend. Yeah. After a lot of powerful attempts had failed, and then eventually it shot lower. Now it's saying, well, we're used to going lower. So are you sure it's okay that we can go higher? So that's kind of why it's seemingly pausing right now. It's wanting to get back in this conservative downtrend that it had been in. So we can, approximate that might be tested again, a prolonging of the uptrend. very much so, though. We're definitely going to get more inventory. Just kind of as a point of interest, I mean, over the course of the 2 years, in January 2018, we only had 4,327 listings. So just kind of over that period of time, we've built up quite a bit, right? So, and we're going to continue to, and you know, once those properties, those pre-sales actually come to completion, you better bet there's going to be a few of those 30 in an instance that are going to show up on the market, and then the other 25, let's say, will be up for rental. So the rental market's going to be very much affected by this in the future. So is the resale market, just simply because there's a ton of brand new inventory that will be introduced to the resale market, even though it's effectively a brand new building, never been lived in, but it's currently occupiable, and that makes it available to the resale market.
Okay. Sounds good. And then with the inventory itself, I mean, if there's a giant, you know, influx of inventory, do you think that's going to be caused by people defaulting on the pre-sales that they've committed to?
That one's kind of an oddity, actually, and that one won't have too much of a movement on the market. So probably what would happen in that case, if you default on it and you just walk away from your investment, the developer will absorb your deposit that you laid with them and keep that property for their personal sale. Right. They might put a few of those on the market, but they don't want to inundate the market and make it look like it's worse than it is, right? So they'll actually put one property on the market, and then maybe in the public comments or the realtor comments say that we have another 10 available, call for details. Yeah. So it is kind of a psychological game there. It's maybe not the most forthcoming, but nobody says in your business that you have to put all your inventory on the market at all the times. But yes, in that instance, probably the developer would absorb it and keep it as an in-house sale. Yeah. And if that market is so overripe with listings, I'd be willing to, like I said in previous episodes, we're going to have to kind of start thinking outside the box. I think the developers will keep a good portion of those as rentals. Rent them out to kind of mitigate some of these costs, because they had so many of them come back and they can't put themselves out there to sell, and maybe wait for the market to come back in 2, 3, 4, 5 years, and then get the price that they thought they were going to get. I mean, you're going to have to change the way that you planned. If you dug dirt right around 2016 and got the pre-sale market, it's going to be very interesting, because the ramifications of such an over hot market to really a cool market by the time they come to online in 2020, 2021 is going to be a drastic thing.
Yeah, that's really interesting to me. I didn't realize that the developers, and it makes perfect sense that they'd sort of artificially manage supply, and then you kind of get into sort of a game theory situation where collectively all the developers would benefit if they all sort of manage supply. But you know, if you have one rogue developer that
wants his money and says, "Here's how many there are, we can negotiate." Let's and we kind of bring that up. A while ago, we had a pre-sale marketing company that wasn't exactly enthusiastic about our downfall, and said, well, that's okay because we can hide our inventory. And I said, well, if your developer listens to that, it's money out of his pocket. Because if they would have achieved the sale by putting it on the market, but then they don't, well, 6 months later, you're at a $20,000 loss. So I mean, it's best to be forthright with the market if you have to sell, rather than trying to do a game theory and beat somebody out of a bad market. It can't happen. It's going to go lower in the near term. If it's 2021, maybe we can do some different things. But as we sit right now, I would be putting my total inventory on the market with as many eyeballs as possible, because there is some people that are out there with a need to buy, and the investors are very much not there. So, the investors know to say, hey, do you have more inventory? The average buyer is looking on the weekends, through the realtor.ca open website, looking at active listings, planning out their weekends, maybe speaking with the realtor. But there's enough inventory on the market that they don't need to go look for hidden stuff, because there's enough there.
Exactly. There's no diamond in the rough to look for. There's diamonds everywhere.
There's diamonds. There's coal, and then 10 years from now, everybody will say that it was diamonds. But over the next 2 years, it might still look like coal.
Exactly. So let's transition into sales figures here. So number of sales, what happened there?
Kind of, again, not too much movement, which kind of replicates it back to the inventory and kind of to the price points too. So when you're not having any sustainable inventory in a month-over-month scenario. What that indicates to us, and with some of the other studies that we do, is that the new inventory is being eroded, being sold. Now, what that means really is they're being sharp to the market. If I come on the listing 20 days ago, I know the new price. The guy that's sitting on from 6 months, he's just not getting a bite. So you can actually come in and sell it at a higher price. Even so, let's say that the new market is $750,000. The client comes on at $760 and they achieve that sale price. That actually makes the market look better than the gentleman sitting at $820. You know what I mean? Because it's a higher valued property that's selling at a lower price. So those guys are going to be that new snack bracket. And the properties that were overpriced at $750, they're just sitting because nobody's coming down to $710. Yeah. No, and then as soon as that new listing comes up at $710 in that building, that one will be sold, and that'll be that new market. Right. So what this signals to us is that the new inventory is being sold. Everything else that's not coherent with this new lower, longer thought is having very, very slow open houses, difficult conversations with their sellers, with the realtors. It's just not very much fun. So you, as we've said before, you do have to get out ahead of it. And still in this market, you have to get out ahead of it, because this 673 might not show up next month, right? We might go down to 651 again. It might hover around here, but lower, longer. So, take advantage of it. Again, for the first-time listeners, what we quote here is Greater Vancouver average sale prices. So on an individual city basis, it does vary, right? Overall, we're expecting a 30% downtrend or recession in the Greater Vancouver market. Well, some markets might be 40%, other markets might be 15%, and it really does depend. So that's where you get in touch with us, and we'll offer the individual static reports for a very minimum price. Each asset class, each region is very affordable, and it unpacks a ton of information. Now, if you're buying, we think you absolutely need it so that you can forecast if you're going to purchase, where it's going to be over the next couple of years, and maybe if you want to hold off in that individual area. If you're selling, we think you really need to purchase it, because how much lower are you going to go? Or are we near the bottom and maybe you want to hold off for another year and get a higher price, or depending on that situation. So if you're in the market, we think you need those at a bare minimum. And if you're not in the market, we still think it doesn't hurt, right? Because if you have a mortgage renewal coming up, which everybody does at least every 5 or 10 years, more than likely every 5, you probably want to know where your mortgage was if you've bought in the last 10 years. How much you've maybe remortgaged, take a second mortgage out to buy the condo. How's that condo sitting? How is it all going to come to ramifications? Because we're seeing a lot of activity already in that mortgage area, and it's obviously tighter restrictive in lending, where if you had a heartbeat and a decent paycheck, they would lend to you in 2016 when prices were astronomical compared to where they are now. So, if you're up for renewal in 2021, that's going to be a very serious conversation. So you might want to order a report, see where you're going to be in 2021, and start planning for it now. Or if you're up in 2020, that's 2015 sale prices, and we're still ahead of those. But by 2021, we're roughly back to 2015, 2014 prices. So that's that scary thing, right? So you do have to kind of gauge how it is. We offer it here on an overall basis, but to really maximize the impact, you need to know what's going on in Port Moody, North Vancouver, Vancouver East, Vancouver West, wherever you may live. And truthfully, if you live in Edmonton, Calgary, Halifax, we do right across Canada, with the exception of Quebec. So please, if you speak French, I don't understand it, and I can't help you, unfortunately.
The poor Quebecois.
Yeah, right? I love poutine, but I didn't really pay attention in French 7 at all.
Yeah, for sure. Before we get ourselves in too much trouble, let's call that a day for this particular podcast. I'm really actually excited about the next one we're going to do too. I think some of these election results will have some implications on where the market's going. So,
Monday's a big day, right, for the nation. That's no difference for big business. So, businesses, real estates, construction, everybody plans themselves for their tax brackets. Well, this election, by almost everybody's estimation, is a very close one. So, they're holding off on decisions until after they know how the ramifications of this election are going to result. So, for sure, real estate every month is important. Next month's going to be even more so important because there's, of course, new data, which is always exciting, and then there'll be an update in the federal election, which has its advantages or disadvantages depending on which province and which real estate territory that you're in for the outcome of the election, and we can kind of fill that in as we go.
For sure. All right, everyone. If you found this podcast useful, give us a big thumbs up, smash that subscribe button, and turn that notification bell on so when we release a new podcast, you'll get alerted right away. So, for Dane Eitel, I'm Andy Park, your podcast host.